welcome to the Masters of Real Estate YouTube channel. This is Mathew Owens. I've flipped over 1,000 houses and have over 35 million lent out to flippers in different markets. And I'm giving you a sneak peek on some of the different interior workings of our Masters of Real Estate course. And I'm talking about alternative exit strategies and some of the things that you can do and how the math works on some of the really cool things you can do in real estate and some of the really cool alternative strategies that you can put in place to make money. So the first thing to understand is obviously you have the traditional flip or the traditional hold investment, of course. And so everybody kind of understands how that typically works. You're making a profit on your flip, and then you're also holding a property for cash flow long term. And I'll break down some of the math. We also have seller financing strategies to homeowners or other investors. So we've sold tons of properties to people's IRAs and 401ks where they can hold the property inside their retirement vehicle, or have seller finance deals via 1031 exchanges for people for their replacement properties. We've done tons of different deals to homeowners as well, where we are the bank and we go and finance that homeowner and make a higher return on investment because of that financing we put in place. There's a wrap around mortgage where you can get a current mortgage in place and then be able to sell the property via a land contract and be able to actually go through and hold and make a profit and hold that asset and that note long term for cash flow as well. And we're going to go over the math of what that wraparound mortgage looks like, because it's really cool from a return on investment standpoint. So you can always do with short-term rentals as well to juice your cash flows in different ways, and even sell off short-term rental investments to other investors that want that. If you want to get it out of a property and not pay commissions, you can always find other investors that want that cash flow. And so setting those things up on silver platters for investors is a great way to get the most out of a deal. Okay. Joint ventures with different investors. You can joint venture with different investment partners that have capital that can put money down or get financing in place and get out of a deal that way, as far as your exit strategy goes, or hold it long term via those joint venture partners, which is an exit strategy of your own capital in that deal and secure it into a long-term hold portfolio. And then there's always funds and syndications where you can, sell your properties or raise money inside of a fund to be able to complete that deal and have your capital exit that deal as well. So let's go over some of the math on a traditional normal fix and flip. You're normally going to go, or a buy and hold type deal, you're going to go buy that property, call it for $110,000. That's, all fixed up and ready to go. I'm not going to include rehab on this because I just want to make sure that it's a real clean and easy transaction for you guys to follow. So normally on that, you're going to put 20 to 25% down. And on $110,000, that's, $22,000 down. And then you have maybe $5,000 or so of closing costs involved. And so you're looking at out of pocket of about $27,000. Okay. And then on a loan of $88,000 or $88,000 total with a monthly payment of about $500 a month at a 5.5% interest rate over 30 years. So that's your basic calculation of what your hold cost looks like, your down payment and your mortgage payment. Okay. And now let's look at what it looks like if you were to sell that property and make a profit via seller financing. Okay. So the first thing you're going to do is you're going to obviously wait until you can sell it for more money than you bought it for. If you bought it right and you're down in it for 110 and you can now sell it for $150,000, that's the best way to do it, of course, to be able to get built-in equity from the start, or renovate a property to get that built-in equity, and then go resell that property on seller financing. We do a lot of 10% down type deals and things like that to homeowners, and we try to match the monthly payment versus what the rent is in the area, so that way, if they ever want to refinance and pay us off, then no problem, they can lower their payment there. But until then, it's going to be really close to what that rental amount is. And so typically in this case, you have a down payment of 10% or 15,000 minus commissions and closing costs, comes down to really only $4,500 back out of that down payment from them. Now, keep in mind that commission is not mandatory. You can market this property yourself on Zillow and Redfin and get it out there in a million different ways and find that buyer yourself. You need to know how to qualify that buyer. You need to know, bring in, if you're doing to a homeowner, you need to understand the laws involved, bring in a licensed broker to handle that transaction for you and all the right paperwork and do the right disclosures for you and things like that. But there's a great strategy to utilize, because this is what happens. Okay, the first thing after you get your $4,500 back, now you're only in it for $22,500 instead of $27,000 because you got your $4,500 back. And then you go and have a seller finance loan. So now you sold it to them for 150 minus $15,000 down. That's a $135,000 loan. And you always want to make your interest rate to them a higher interest rate than what you're paying to the bank. Okay, and realizing the buyer can go through and refinance anytime, but maybe there's a million reasons they can't get traditional financing. Maybe they had some previous medical issues and had a credit report ding and they need to wait till that gets cleaned up, or they're self-employed and don't show a lot of income, but you can understand through depreciation add backs and some of the things that they've done that they're making enough money to qualify for the property in itself, but the bank may not see it that way. There's a lot of, maybe you're dealing with a realtor that had one down year and all the other years are high and they're showing good income this year. So there's a million ways of reasons why someone wants to buy this property, and they know that, hey, if they just want to own the property even at the higher interest rate. And so, at this point, you're looking at $1,081 a month in a payment versus your $500 payment that you're making, which is a $581 per month profit, or $6,972 per year in this example of profit by doing a seller finance strategy on your $22,500 left down, which is a 31% return on investment. It's pretty interesting. And on top of that, you also want to look at this from a return on equity. If you were to go and sell that $135,000 note and get all of your money back minus your current loan, it's a $47,000 of actual equity in there. If you were to sell the note, you're making about 14.83%. In addition to that, realizing that your amortization schedule at 5.5% is paying down at a much faster pace than that 8.95% interest rate to the homeowner, meaning you're paying down principal faster than they are, and your spread is getting bigger and bigger and bigger for over a period of time, which is absolutely amazing because your profits are getting higher and higher. The biggest negative about seller financing is it's not necessarily an inflation hedge. You could do some sort of profit participation promissory note or something along those lines. Gets a little hairy legally, and you want to make sure that you're in the right market and have the right team in place to do that. But great strategy to utilize. You don't want to go and take title out of your name in this situation. You want to make sure it's a land contract, meaning title doesn't change. It's almost like a lease option type contract where they have the option of buying that property at the amortized balance at the time, or they can refinance at any time and pay you off. But you don't want to transfer it out of your name, because a lot of times on those mortgages, you have what's called a due on sale clause. And if they ever call that due on sale clause, you want to be able to have the resources to pay that loan off and comply completely with any issues there if they do decide to call that loan due. Because when you transfer the beneficial interest in a property to another party, then they have the right, not the obligation, but the right to call that loan due. So understanding your legal documents here is absolutely key to a successful wraparound mortgage sale like this. But if you could get all of your money invested at 30% plus rates utilizing this strategy, how fast can you retire off of cash flow, and how much resources do you need to be able to do that? So I hope this helped you guys. This is a sneak peek at the Masters of Real Estate course. It's a 6-month real estate course that we teach on every aspect of real estate investing, including the right business structures, the right tax and legal structures, the right analysis on how to fix and flip, how to buy and hold multifamily, how to actually invest in your self-directed IRAs, how to raise capital on your investments. All of the different strategies that go into real estate, we cover in this 6-month course on real estate. If you're interested, hit us up and we'll talk further. Thank you guys very much. I appreciate it and look forward to working with you guys in the future. Talk to you soon.